gold could be the core hedge of 2026. And the reason has less to do with hype and more to do with how the global financial system is evolving under pressure. According to Bank of America, gold is projected to average around 4,538 euros per ounce in 2026, a level that reflects persistent macro stress rather than a short-term trade. This outlook, highlighted by Michael Widmer, is grounded in structural forces, elevated sovereign debt, long-term fiscal imbalances, and a global monetary system that remains highly sensitive to confidence and liquidity. Even if inflation moderates from recent highs, real yields are expected to remain volatile, and that environment historically strengthens gold's role as a portfolio stabilizer. Central banks have already been signaling this shift, with sustained gold accumulation as reserves diversification continues, away from dollar concentration. Gold in this framework is not about chasing returns. It's about protecting purchasing power and reducing systemic risk. Silver, however, plays a very different role in the same cycle. While Bank of America sees gold as the primary hedge, history suggests silver behaves as a high beta extension of monetary stress, often lagging early and then accelerating sharply later in the cycle. Based on historical gold-silver ratio extremes, silver prices could peak anywhere between 35 and 309 per ounce during a full reflationary or confidence-driven move. That range sounds extreme, but it reflects silver's dual nature as both a monetary and industrial metal, making it far more volatile when capital shifts aggressively. The key takeaway is that 2026 is shaping up as a two-metal story, gold providing the foundation of stability, and silver offering asymmetric upside once conditions align. Markets are beginning to price this distinction, and understanding the difference between hedge and performance may be one of the most important portfolio decisions heading into the next phase of the cycle. What makes this outlook especially compelling is how the macro backdrop into 2026 aligns almost perfectly with the historical conditions that favor gold first and silver later. When financial stress builds, capital typically moves in stages. The first move is toward safety and liquidity, which benefits gold as a hedge against currency risk, policy uncertainty, and systemic imbalance. That's exactly what we've been seeing as government debt levels remain elevated. Deficits persist, and confidence in long-term fiscal discipline weakens. Even if interest rates eventually decline, they are unlikely to fall back to the ultra-low regime of the past decade. Meaning volatility in real yields will remain a feature rather than a bug. That environment supports sustained gold demand from central banks, institutions, and long-term allocators. Silver, by contrast, tends to underperform during the early phase of this transition because it is more sensitive to growth expectations and industrial demand. But once markets shift from hedging risk to seeking performance, silver historically begins to outperform sharply. This is where the gold-silver ratio becomes critical. When that ratio stretches to extremes, often above long-term averages, during periods of stress, silver's subsequent mean reversion has produced outsized moves. That's why forecasts for silver can look extreme compared to gold. They are not linear projections. They are based on cycle behavior. In previous monetary stress cycles, silver didn't move gradually, it moved explosively once confidence fractured and capital rotated aggressively. If gold anchors portfolios in 2026, silver becomes the expression of excess demand, leverage, and speculation layered on top of that anchor. Understanding this sequencing is essential because it explains why silver's upside potential exists. Because gold does its job first, not in spite of it. Another critical element behind these projections is how liquidity and policy response tend to evolve late in the cycle. By the time markets move into 2026, the question may no longer be whether growth is slowing, but how policymakers respond to accumulated stress across debt markets, credit conditions, and global trade. Historically, when policy flexibility becomes constrained, either by inflation, sensitivity, or fiscal limits, gold benefits from being the asset with no counterparty risk and no dependency on growth. That's why gold often performs even when traditional safe assets struggle. Silver, however, reacts most aggressively when policy credibility begins to erode, rather than when stress first appears. This distinction matters. Silver's sharp upside phases have typically coincided with moments when liquidity injections, currency debasement fears, or confidence shocks accelerate simultaneously. In those environments, silver's smaller, market size and dual-use nature amplify price movements far beyond what fundamentals alone would suggest. This is also why silver tops tend to be volatile and brief. They are driven by intensity, not stability. From a portfolio perspective, this means silver is less about continuous protection and more about timing and exposure management. The same forces that support gold steadily can push silver into extreme territory quickly, but they can also reverse just as fast once conditions normalize. That asymmetry is exactly what makes silver compelling and dangerous at the same time. Understanding that difference helps explain why projections for silver appear wide and why investors who treat silver like gold often misjudge both its risk and its opportunity. What investors often underestimate is how behavioral dynamics amplify these moves once metals enter the public narrative. Gold's role as a hedge tends to attract institutional and central bank capital first, slow, steady, and relatively price-insensitive. That capital provides a floor and reinforces gold's status as a monetary asset rather than a speculative one. Silver enters the picture later, when confidence in paper assets weakens further and capital begins searching for leverage within the same theme. At that point, participation broadens beyond institutions to include funds, traders, and retail investors, all drawn by silver's lower nominal price and higher volatility. This is where price action becomes nonlinear. Silver does not rise because fundamentals change overnight. It rises because capital concentration increases in a much smaller market. The supply side cannot respond quickly, inventories are thinner, and marginal buying pressure has an outsized effect. This dynamic explains why silver historically overshoots fair value near cycle peaks. It is not repricing stability, it is repricing intensity. For investors, that distinction is critical. Silver's potential upside exists precisely because it is unstable at extremes. Those extremes create opportunity, but they also demand discipline. Unlike gold, which can be held comfortably through long periods of uncertainty, silver requires a clearer framework for entry and exit. As markets move closer to 2026, the risk is not missing silver's upside, it's mistaking volatility for permanence. The bigger picture that is developing in 2026 is shaping up to be a critical year for determining how portfolios strike the right balance between protection and performance. The projected strength of gold reflects the fact that a world where debt burdens, policy constraints, and geopolitical uncertainty remain at high levels makes hedging a fundamental necessity rather than just a choice. Its main role is to efficiently absorb stress, quietly and consistently, throughout the market cycle, rather than delivering dramatic and unexpected returns. Conversely, the role of silver is quite different and represents what happens when those same pressures push markets beyond equilibrium. What sets silver apart is its more volatile, less predictable expression of monetary tension and liquidity distortion. Consequently, this unique aspect of silver's potential lies in its ability to showcase a U-shaped pattern, where levels reach a peak and are then unable to persist for an extended period of time. For investors, the main lesson to be learned from the metals story is not to differentiate between gold and silver, but instead to acknowledge and understand the distinct functions that each of these precious metals have in their portfolios. As the year of 2026 approaches, the central theme of the metals story is less about price targets and more about understanding the important aspects of sequencing, liquidity, and behavioral patterns. Investors who recognize and appreciate these different aspects will be better positioned to navigate the stability gold provides, while also being able to capitalize on the explosive phases silver can deliver when market conditions align in a particular way.